When most investors see a net lease deal for AutoZone, Midas or Valvoline, they assume one thing. It's corporate. But the truth is, many of these are operated by franchisees. And that changes everything. Today, we're breaking down the difference between corporate and franchise tenants in the auto sector, and what it means for your risk profile and your returns. Let's start with corporate leases. Corporate leases are signed directly by the national company. That means the parent company is responsible for rent. You're typically working with an investment-grade tenant. There's more standardized lease language pros, more predictable credit, less risk of default, often better locations and cleaner terms, lower cap rates, limited flexibility to negotiate, slower to communicate or approve changes. Now, let's talk franchise leases. These are signed by an individual or operating entity that licenses the brand. So even though the sign says Midas, the lease might be with Joe's Auto Group LLC, a 5-store operator in Kansas, a regional franchise group that owns 20+ stores. Pros: higher cap rate, more flexible terms, sometimes better customer relationships. Cons: higher risk of default, guarantees may be personal or weak. You must vet the operator, not the brand. How to tell the difference? Look at who's listed as tenant on the lease. Does the entity match a public company? Is there a personal or corporate guarantee? Can you find their credit rating or financials? What about leasebacks? Many franchise auto tenants do sale leasebacks. They own the real estate. They sell it to raise capital. They sign a long-term lease as tenant. This can be fine if they have a strong financial track record. You get a solid guarantee. The location is viable, even with a new brand. Vetting the franchise tenant. Ask: how many stores do they own? How long have they operated? What were last year's sales at this location? Is there any litigation or pending bankruptcy? Also, review credit references, store P&Ls if available. Third-party franchisee ratings. What to watch for in the lease. Franchise leases can include limited guarantees, weak maintenance provisions, rights to assign to other franchisees without consent, push for, personal guarantees if corporate is too small, detailed maintenance clauses, minimum sales thresholds if % rent is included. Which one should you buy? It depends on your goals. If you want stable income, minimal work, safer yield, corporate lease may be right. If you want higher returns, room to negotiate, more upside with risk, franchise tenant deals can offer value, but only if you vet them like a lender. Wrap up. The biggest mistake you can make is assuming a national brand equals a national lease. Look past the logo, know who's really paying rent, and underwrite the lease, not the name on the sign. And subscribe for more CRE insights every week.